Hi, I'm Rob B, and of course with Rob D. And you are listening to the Property Podcast, episode 233. Now, often in property, things get spouted around, best practices, headlines if you like, and then they're just taken as truths. But that doesn't go down too well here at the Property Podcast. We need to dig deeper. We need to give you the full story. So this week, we're looking at investing through a limited company, but making you aware of the things you're just not told.
Yeah, it seems like a good time to be doing this episode. We've had Section 24 in place for a few months now, and it has been talked about and planned for a good couple of years before that. So there's been loads of talk about limited companies. That talk has translated into action. We've shared news stories in the past about how many people are using limited companies now. So we've seen a lot of cases with people investing through companies. And there are definitely some little wrinkles and some considerations that people tend not to be aware of going in and wish they had known going in. So that's what we're going to be sharing with you today.
We will be, but first we'll be sharing our thanks. Thank you so much to everybody who contributed to our trades help request. What is that, you may ask? Well, you're clearly not a regular listener, because last week we put an appeal out. Yellow Lettings is growing really, really quickly. And while that is exciting and super fun, we cannot keep up with finding enough tradespeople. We've got them, but we need and want more. So we put a call out to you, dear listener, and we said, please, can you help us? Can you supply us with more tradespeople that you trust and would recommend? And you did in your droves. Thank you so much to everybody who contributed to that. If you are listening to this for the first time, or you listened last time and thought, oh, I must do that and didn't get around to it, well, the form is still live and we'd still appreciate your help. If you go to yellowlettings.net/trades help, that's trades help, all one word. If you go to that URL, of course it'll be in the show notes, but if you go to that URL, fill out a very quick basic form, and trust us, you will have our thanks for a very long time. We really appreciate everyone who's done it so far. Thank you so much. And for those who are thinking, oh, I must do that now to help these lovely Robs out, then thank you too. It's helped us solve a bit of a headache very quickly. The power of the podcast, Rob.
Yeah, and it makes us look good in front of our team at Yellow. We go, oh, we just sorted that out for you. No worries. It makes us look good. We've barely had to do anything, which is always our favourite kind of situation. So, yep, thank you for that. In other news, Rob, I believe you've just been past a very important milestone for RMP.
Very important. Long time coming. Hardly talked about it on the podcast. I don't know why, because normally we talk about everything pretty openly, a bit like today's episode. And it's not because I've been trying to hide anything. Maybe it's nerves and I just wanted it to happen and go through. But now's the time to kind of talk a bit more openly. And RMP have started developing, which is super, super excited. I'm not going to go on about it too long here, but there'll be plenty of podcasts on the subject coming up. But the milestone was we launched and in the same evening sold out, in fact oversold, our first development, which is in Crewe. A lot to learn from what we've done already in terms of finding the land, why we chose the area, some of the headaches about buying the land. There's so much learning and lessons that I'm going to be able to pass on now through the podcast. So the people who've invested, I'd like to think they've won because they've got a great deal and I'd like to say a great developer. But also, listeners, you're going to win because now I can bring even more lessons to you from directly running that company and building that company and building those properties. So much more content to come on the podcast because of that. So super excited.
Yeah, I know you're not going to be hoarding that knowledge. So congratulations for that. That is really huge. So get your hard hat on and get to work. You've got some houses to build.
I can't wait. Rob the Builder, as I keep telling my family, to the ever-consistent groans.
You know your audience. Right. Okay. So that is a lot of goings on, but we just need to quickly mention as well that meetups are next week. Reliably, the first Thursday of every month is meetup day. There's loads of them. There'll be one near you. You should go. It's free. If you haven't booked your place, just go to thepropertyhub.net/meetups. You can book your free place and you can go and meet lots of lovely people. So if you don't have anything in the diary for next Thursday, that's the 7th of September yet, make that happen.
Yes, indeedy. And before we make our main topic happen, I think there's a really important news story this week, Rob, which for those, if you're a little bit nervous about the property market now, might give you a bit of comfort because somebody who's dubbed as a superstar investor by the media is pretty keen on property.
Yeah, so this is Neil Woodford, fund manager, the darling of the press, like you said, Rob. He's always the one who's tipped and quoted, and people are watching very closely what he does. An interesting side note on this, actually, before we get to the main point of this, is that he's performed really poorly this year. His fund has lost 2.8% over the last year. If you'd invested in the average fund over the last year, you would have made a gain of 10%. So just a little note there that superstar fund managers tend not to always be that way. Someone will perform really well for a while and then they'll fall from grace. For Mr. Woodford, it's too early to say whether it's a fall from grace or just a little blip, but he's looking to bounce back from this. And the way that he's doing that is by piling into property shares. So he's bought into a couple of REITs. So one that owns office blocks outside London, another one for retail units. He's also bought into house builders, Redrow and Crest Nicholson. And he's bought into British Land, which is a massive property developer. So what can you take from that? Well, not that you should be blindly piling in as well, definitely not. But it does clearly mean that he is not bearish on property. All of those companies and those funds will only do well if the property sector as a whole does well. So clearly you'll start to see more doom and gloom in the press. We're talking about that, but he seems to think that there's lots of upside to come.
Yes, and as Rob said, don't just blindly follow him and invest in those companies, which nicely leads us into this week's podcast. Because while some people are investing through limited companies, and rightly so, because that is a best fit, and they've understood the pros and cons of their decision, many people don't, Rob. In fact, it's not being talked about anywhere, so that's why today's podcast exists.
Yes, it's a really hot topic, investing through a limited company. It has been for a long time, and it's one of the biggest changes that I've seen in property, actually, this sudden dramatic swing to almost everyone, it seems, using a limited company. And the reason is obvious. You'll probably know by now that the main reason people do that is tax. Because of Section 24, it avoids that nasty new tax treatment, and therefore everyone is doing it. The worrying thing, though, is that we see lots of people going down the limited company route without seeking any advice at all. And that's worrying because it's never going to be 100% positive. There's always going to be lots of factors to consider. So the purpose of this podcast isn't to put you off at all, but it's to highlight that there's more to investing through a limited company than you might have thought. There's pluses, there's minuses, there's things that are neither plus nor minus, but just things to know. And we feel like no one's having the conversation about what it's actually like to invest through a limited company and all the things you need to be aware of. So that's what we're going to do today.
We are, and let's kick off the list. Now, Rob, most people go into a limited company to save money. But actually, while you might save money, and for some people lots of money, there are also costs involved too.
Yeah, there's probably about 4 areas where investing through a limited company and using a mortgage, and most people are in a company and using a mortgage, so we're going to assume that's the case for all of this. So there are 4 areas where it's going to cost you more. So there's the rate on the mortgage. Limited company mortgage rates are coming down. They're coming down really quickly. The spread is a lot smaller than it was, but they're still more expensive at the moment on the headline rate. The fees tend to be higher as well, largely because the lender's got more work to do. And you've got more work to do as well, which we'll come to later. The legals are going to cost you more because your solicitor has got more work to do. There's just more paperwork to deal with. So that's going to cost you more as well. And on the accounting side as well. If you're using an accountant, the accountant will charge you more for doing a limited company's account because, again, more work for them to do. And if you've been doing your accounts yourself, you're probably not going to be able to do that for a limited company. Therefore, you'll need to employ an accountant. So that's 4 areas in which the costs are higher. The saving that you've got is on the tax. So the calculation for you to make on the costs alone, there are other factors as well that we'll come to, but just on the costs, well, are you going to save more tax than it's going to cost you in all those extra things that I just talked about? Now, that's where timescale comes into it, because if you're only going to be holding that investment for a couple of years, then those costs are probably going to outweigh the tax savings. Very much depends on your situation and the property, but that's a lot of extra cost over not much time. So the majority of people investing are going to be investing for multiple years, decades, possibly even forever. And if you are going to be holding forever, then there's inheritance tax advantages to having it within a company as well. But if for any reason you're only looking at an investment for a short period of time, just a couple of years, then it's very possible that by the time you've done the maths, the costs will outweigh the savings. So like I say, for the vast majority of investors, you'll be holding long term. And so chances are the costs will sort themselves out and the benefits will outweigh the costs over a longer period of time. But it's something that people tend not to talk about, so worth flagging up now. Another thing where I don't know if this gets talked about enough, Rob, is the time that it can take to invest through a limited company.
Oh, yes. Felt the pain on this one. So it can take months to get through a mortgage through a limited company. Now, that's not that uncommon, actually. It may sound like an extreme, like, oh, well, occasionally things can happen and it takes months. But actually, I would say a limited company mortgage, from my experience, and I see a lot of these mortgages, takes on average around 3 months. It doesn't go much quicker than that. It takes a long time. As Rob's touched on already, there's a lot more work to do from a legal point of view. So you've got to jump through all those hoops. But the lenders also want so much more information from you. And you have to put plenty of effort in too, which we'll come to shortly. So it's really, really important to be aware that you can't just turn around a mortgage in 6 to 8 weeks like you can if you bought through your own name. It is a slow process. Now, I've given you the average, but I can give you a bit of a horror story. I bought a property at least 18 months ago now, and a limited company mortgage wasn't going through in time, so I had to buy cash. So I did. So I expected within a couple of months to have the mortgage sorted out, cash back out, crack on, everyone's happy. Well, as I say, that was at least 18 months ago, and that mortgage is still not through. Now, it is not just because it's a limited company mortgage. I have to point that out. The solicitor, who I no longer recommend to anybody, is shocking. And their experience, because it's a bit of a new market, to give some balance of limited companies, was zero. So they really didn't know what they were doing. They didn't have a clue. Unfortunately, they didn't really have any desire to learn either. And that's been very, very painful. But the lender, when you think you've done everything they want one more thing or one more tweak. And actually, I'm at the point now where they are looking at how my tax affairs are set up and asking me to change certain things in my tax setup so they're happy. Yes, that's how detailed and hands-on they are. I'm at the point of just telling them to go away, but it's because we've gone so far for so long and we keep thinking we're right at the end that I've carried on. That's an extreme example, but one that you need to understand. So, if you're going into a deal and the vendor is keen to get this tied up quickly, going through a limited company mortgage may not be the right route forward. I'm not saying don't invest through a limited company, but you may want to buy cash first and then look to refinance later when the time pressures are off. Also, this should give you more lending options as well, particularly if you're buying a new build, because if you're buying a new build, there's less options the first time you buy through a mortgage, but then when you go back second time round, it's classed as second hand, so it opens more options again. But even if you're not buying new build, this still may be worth considering just because of the speed of cash and then taking your time to refinance once it's all done and the dust is settled and you've got the deal signed and delivered. You don't want to have the pain of losing a deal that you've worked so hard to get in the first place. I've seen it happen. I have, unfortunately, many, many times, because the deals I work on need to move quickly and limited companies do not move quickly.
No, that's definitely something you need to be aware of. Also, if you don't have the cash in that situation, then you could take out a sort of a medium-term bridge to purchase the property and then get a mortgage after that. But of course, that's going to cost you a lot more. So that ties back into the first point about the higher costs. And will you manage to make that back with savings compared with if you were just owning as an individual in the first place? Now, here's something else that you might not be aware of. And to be honest, I wasn't aware of this until we started seeing it and hearing stories from people. The extra effort that you need to make if you're going to be investing through a company. As Rob's already mentioned, lenders tend to want to see a lot more stuff. There's all the company documents to track down. If you've got existing properties, they're going to dig into that far more. If you've got existing properties in a company, they'll want to know even more about that. There's lots of stuff that they're going to want to see in terms of paperwork. Now, as we talked about very recently with the changes to the mortgage rules, if you're considered a portfolio landlord for mortgage purposes, then you're going to have to start producing a lot of this paperwork anyway. So maybe that's not such a difference. But compared to just having one or two properties in your own name, you are going to need to do a lot more paperwork for a limited company. Another thing which you will only have to do if you're investing through a company, and which is probably the most annoying bit, is that you'll very often have to actually go and see your solicitor in person and have them read something out to you in exchange for money. It's like the world's most expensive bedtime story. They will read out to you the personal guarantee that you're going to have to sign to make sure that you understand exactly what you're agreeing to. They're not doing that to be nice to you. They're doing it because the lender needs to know that you're not going to wriggle out of that commitment later and say, oh, I didn't understand what it was. And your solicitor is going to charge you more for doing that. And that needs to be done in person, and you're going to be charged for doing that.
It is so painful. I've done it. I had to sit in front of a solicitor while he explained this to me. Now, I'm not a know-it-all, But in property, I feel fairly confident. Fortunately, though, because the solicitor realised that I knew what I was doing, he actually gave me a discount because he felt sorry for me that I had to sit there in front of him while he read it back to me. So that was one upside. Didn't give it for me for free, but did give me a discount.
Yeah, it's super annoying. And I've been involved in deals through LendSwift where we've been lending, where it's really held things up because the borrower wasn't aware of this and they were remote from their solicitor and they had to make arrangements to travel or have another solicitor locally do it. And it's a real pain. There was also another case where we had a company with 4 directors who all needed to give personal guarantees. One of them was abroad, and trying to coordinate that just took weeks. So again, it's another thing that slows things down and causes you work. It's not a deal breaker. Of course it's not. If it's the right thing for you to do, then you make the effort, you suck it up and you do it. But it's something that you should be aware of before you start so you can plan for it.
Absolutely. Another thing you should be aware of is lack of options. There are currently no major mortgage lenders operating in this sector. We think it'll happen very soon, but currently there isn't. And there are less lenders, understandably, compared to buying for your own name, because buying for your own name, that buy-to-let system's been up and running since the 80s, so it's a very mature market. Limited companies, not so much. So there's not as many products out there. It's getting better. This absolutely isn't a doom and gloom episode, but at the moment, currently, there aren't as many options. And when I started 18 months ago, there were even less. So I've seen an improvement. I don't think the scenario I talked about before would repeat itself now because solicitors are a little bit more switched on. There are a few more products. Lenders are a little bit more relaxed. However, all being said, there are less options. So what does this mean? Well, what it means is if you've got a property that's slightly unusual, and I don't mean made out of straw, like completely unusual. I mean slightly unusual. Maybe the height of the building, its proximity to certain things. Not stuff that you'd think, oh, that would make it a bad investment. But just away from the normal 2 up, 2 down property made of brick. Anything away from that immediately starts to rule lenders out. The smallest changes means that crosses go through who'll lend to you. And you may find that if you go to get lending and your limited choice says no to you, then after that, you may be really struggling. Now, this is only going to play out for certain people in certain circumstances, but again, it's not being talked about. People go for a mortgage, their lender will say no for whatever reason because of the criteria. They don't like something. I don't know, maybe it was painted blue and they wanted it painted red. They seem that picky sometimes. The point is, if that lender says no, then you may be struggling from that point on to get a mortgage. So I think this is a short-term challenge with limited companies, because it is getting better, but it is a challenge right now, and it's something you should be aware of.
Yeah, and there's another point related to that as well. This is a new market. There are more and more lenders coming in all the time, but the whole field of limited company lending is very new. And that means that it's highly unlikely. But if anything happens to the property market now, then you could be in trouble because all those lenders could suddenly go away again. Now, I hesitate to mention this because I don't want to scare anyone. I think this is a really, really unlikely situation. But I know that people have concerns about different things, and it's worth knowing everything and just deciding whether that worries you or not. If the property market did have a bust right now, then those few lenders might decide that they're not interested anymore. Then suddenly you've got a loan that you can't refinance because there aren't any more lenders. That would mean that you'd be sort of stuck on their standard rate, and that could end up being pretty high. Again, I need to emphasize that I do not see this happening. This seems extremely unlikely. And by the time we do get around to the next crash, whenever that is, there should be loads more lenders in the market. The limited company market should be entirely mainstream. And at that point, you've got a market that whatever happens isn't just going to go away. But it's just a timing issue related to that lack of options that Rob was talking about a minute ago. And something to bear in mind if that's the kind of thing that scares you.
Yeah, agree. Absolutely don't see it happening. But because it's a scenario that could happen, worth mentioning, but agree, don't see that happening. So now you're informed, you can decide if a limited company is right for you. And that's the point, now you're informed. So many times, people just go blindly into limited companies without even understanding if they benefit from a tax point of view in the first place. A lot of people I've seen go into limited companies because they think it's the right thing to do and have no idea if it benefits them from a tax standpoint. Now, that's worrying because when you go through the things we've talked about, you've got to be better off tax-wise to invest through a limited company. Otherwise, you wouldn't bother with the above challenges. So make sure you understand that you will be better off from a tax point of view. I absolutely am. No-brainer for me. So I invest through a limited company. And as much as I like to moan about the stuff we've just gone through, I suck it up because ultimately the tax benefits outweigh the heartache and the pain and all the rest of it. So it's right for me. But just because it's right for me, don't go and set up your limited company tomorrow and then start investing. Understand your tax situation. Get advice, get professional advice, and then if you're told, yes, this is the right thing to do, crack on, do it. And at least you know what you're getting yourself into. This episode is not about why you shouldn't invest in limited companies. It's about make sure you understand what happens once you invest, so it's not all shocks once you've started. By the way, investing through a personal mortgage isn't all roses, unicorns and rainbows either. There are challenges there too, but most people are aware of them. What hasn't been discussed up until now is what happens when you go through a limited company. So hopefully you're better informed. And if you're at a property meetup and you hear somebody saying, oh, I'm not sure what to do, should I invest through a limited company? Point them over to the podcast because we can help them out. And coming up, we've got a resource that will help them even further.
Yes, we have, but we cannot reveal that resource until we've given thanks to some lovely people who've had some lovely things to say about us over on iTunes. Well, I hope they have, Rob. We've got the iTunes review section. They're normally nice, but could it be different this week?
No, they're nice. So thank you very much to these wonderful people. So our first review says, really good stuff. I've been listening to podcasts for a couple of months now and tried to catch up with all the previous episodes. I saw you guys live in London at the Discovery Day for your companies, but I didn't come to talk to you because I was afraid you would ask, did you leave a review? And I would have to confess, no. So now I've done it, guys. Really useful content and great resources. One more thing, until the day I'd only seen photos of you on their website and assigned the wrong pictures to your voices. I thought the skinnier Rob was the one with the northern accent, but I saw you talking and now I take the truth as it is. I think I'll have a salad for lunch. And our next review is... our next review says, always have pleasure listening to the boys. It's like chatting with mates down a pub. No egos, no hidden agendas, just great advice. Thanks. Thank you to the reviews. And yes, Jim, followed by salad, followed by Jim. And hopefully next time we'll be equally skinny, Rob.
Well, I'm going to be hitting the gym to bulk up some more. I'm quite disappointed that my efforts in the weight room haven't gone noticed. So managed to offend both our egos at the same time there. But we do love those reviews, whatever you are saying, as long as it's nice about the podcast. And you know what? You were right. We would have asked you if you'd left a review because I ask everyone and shame people into it, which is why we've got so many.
Yeah, it's not because you like us, it's peer pressure. Right. But hopefully you will like us when we give you the resource of the week because we put a fair bit of effort into it. And like us because we'll be back next week with another podcast, which we'll let you know what that is in a minute. But before we do, Rob, resource of the week, it's one of our own, but it's right to remind people that this exists.
Yeah, absolutely. We've got a whole load of free courses if you go to thepropertyhub.net/courses. One of those is called Should You Use a Limited Company to Invest in Property? And in that course, we run through the main arguments for and against, who it might suit, what to be aware of, and all that kind of thing. It's not a replication of this episode at all. We're talking more about the detail in this episode, things that we've observed now further on from when we recorded the course, having seen a lot of people go through this and go through this ourselves. But we've kind of been assuming in this episode that you understand the basics. This course is great for the basics and giving you the big picture overview. I get lots of emails where people say, I can't decide whether I should invest through a limited company or not. I just send them a link to this course. Not because I'm trying to be dismissive, but because that's where the answers are. You'll still need to go and get advice, but you'll get so much better advice from your accountant or your broker or whoever you're talking to. If you understand it yourself first, you can check that they're asking you the right questions and they know what they're talking about. So it's free. It's nice and visual. It's an easy watch. So just go over to thepropertyhub.net/courses and you'll find it living there alongside lots of others that you might want to check out too.
Yeah, make sure you bookmark that page because we're updating them all the time. We're constantly investing our time and resources into putting out new courses. It does take a bit of effort and all the editing and blah, blah, blah. But ultimately, you give us nice feedback, so we'll keep making them. So check out that course. But also, if you haven't, check out the others and bookmark the page because we update it fairly frequently now. Another thing we update fairly frequently, Rob, is the podcast. Every Thursday and Tuesday with us, Rob and Rob. But next Thursday, we're back with a good one, and it's comparing ways to get a high yield. So there are different approaches to property. Some people are in it for the capital growth. Some people are in it yield. Some people are in it for both. But for those who need income now, how can you get a high yield? There are some obvious ways, but next week we're going to dig deep and make sure you fully understand the full range of options you have at your disposal to get that high income, to get that high yield, to get the cash rolling in from day one. So that's next week's podcast. And again, just an extra thanks to everyone who's helped us with the trades recommendations for Yellow Lettings. If you have anybody that you would recommend, then please go to yellowlettings.net/tradeshelp. That's /tradeshelp. And we will gladly take your recommendation and contact them. So thank you so much for those who've done it and those who will. And of course, Rob, meetups next week.
Yep, what better way to spend your Thursday evening? I can't think of one. Go and meet lots of lovely property people, talk about everything in this episode. Here's some real life experiences. There'll be people there who've invested through a company. They'll be able to give you their war stories as well. Always a great way of getting direct from the source knowledge from a whole range of people who are happy to share. Just go to thepropertyhub.net/meetups for that. So that is next Thursday when there'll be a new podcast for you as well. But before that, we'll see you on Tuesday for Ask Rob and Rob. Until then, have a great week. Bye-bye.
Bye-bye.
Thanks for listening to The Property Podcast. For show notes, all our past episodes, and to leave a review, go to thepropertyhub.net/podcast.